So my name's Katherine Krajnak, and I work for the Portland Development Commission. And that's basically the economic development agency for the city of Portland in Oregon. And my portfolio is a group of programs that focus on supporting diverse entrepreneurs really early on. So I have a publicly backed incubator in my portfolio and just launched an inclusive seed fund this past year. So we have a really dynamic panel today. And just before I have them introduce themselves, I just want to get a sense in the audience, like, who's a startup founder? Okay, great. Who's currently raising money? You want to raise money? Okay. Who's not raising money but wants to raise money? Okay. And then I'm just going to ask one more question. Like, who feels like, I'm kind of new to understanding venture capital or angel capital. I'm not really sure about, it sounds like a foreign language to me sometimes. Okay, great. So one thing I want to say is, if you are kind of like confused and like, man, I don't know what they're talking about, if you Google Tech Inclusion Community, there's an online community for this conference, and we're going to post some resources about raising capital, about understanding capital that these awesome panelists have given me. So just want to let you know that there's a lot to understand about this world, and if you're new to it, don't feel intimidated or anything, because it takes a while to kind of understand it if you're new to it. So with that, what I'm going to ask the panelists to do is just introduce themselves and give some information about what stage of company you invest in, also the types of companies, and anything else that's really important to know about you as an investor or about your firm as an investment firm.
Good morning. I'm Cynthia Maxey. I'm with B Partners. We are pre-seed, so we're the people who invest in you after friends and family. We invest pre-product and pre-revenue. And we're first investor in over half our portfolio.
Good morning. I'm Phin Barnes. I'm a partner with First Round here in San Francisco. We have offices in New York, Philadelphia, and San Francisco. We're a seed stage venture fund, so we're typically writing checks somewhere between $500,000 and $1 million in rounds that are around $1.5 million to $2 million. We like to be the first institutional capital that entrepreneurs take, and our view of building companies is that by bringing a community together around company building, we can help entrepreneurs build better companies together.
Morning. My name is Nima. I'm with OATV. We're one of the oldest seed firms in the country back when they didn't call us seed firms. First Round was actually one of them as well. With our fourth fund, we're taking a slightly new approach to funding companies. We're calling the style of investing Indie VC. If you ever needed a burning unicorn GIF, go to indie.vc. You're welcome. We're basically removing ourselves from the game of fundraising, and we look to back bootstrap, profitable entrepreneurs who want to build independent businesses. Happy to talk more about that with the panel as we go.
Hey everyone, good morning. My name is Sarah Gua, and I work at a firm called Greylock Partners. We are an old traditional venture capital firm, so we're in our 53rd year. We just raised a $1 billion fund. It's our 15th fund. And we basically invest in anything that's software driven, so consumer and B2B software. So we look for 4 basic things in companies: compelling founders that we can get excited about, a unique offering that is somehow, we think, going to be structurally defensible in the market. So we think a lot about network effects and platform effects. Big markets, and then some shot. Every one of these journeys is long and improbable, but some shot at a outcome on the tail end of the distribution, right? Building a durable company that's huge, that could be around for a long time and independent. And it's great to meet all of you. I think an important thing to think about for Greylock is our team is diverse and our founders are diverse, and it's something that we really care about.
So I just want to follow on that because we are at a Tech Inclusion conference. So I was just wondering if each of you could give a little more insight in terms of like how you approach kind of sourcing a really diverse pipeline of founders, or if you have like a story or example around that, and just how that looks for you.
So we've been blessed with some amazing founders in our portfolio. We have some extremely dynamic female founders. We also have minority founders. However, our best source of introductions comes from within the people who we run with, so our community themselves. As pre-seed investors, oftentimes as somebody like Phin and Sarah meet somebody and it's too young for them, they will refer them to us, and we refer back to them as well.
So we have a similar story about where our new investments come from. So in the last 12 months, close to 60% of our new investments were referred by our existing portfolio of founders. And as we look at the landscape, we recognize the challenges with diversity and inclusion. And I think, it's when we think about where First Round is, I think we've sort of evolved our thinking from being open and feeling like our job was to view founders as they came in equally and do our best to eliminate biases and so forth in the investment process. I think that thinking has evolved quite a bit over the past couple of years, and at this point our approach, it's not figured out, like I'm not claiming victory by any stretch, I think, but our approach has been to really focus on our superpower, which is community. And to look at if over 60% of our investments in the last year have come from our community and referred from our community, then if our mission is to help build and support the strongest community of entrepreneurs, the way to do that is to build a diverse community. And so we're really very focused on making sure that our community events, from our large events like CEO Summit all the way to the dinners that we do, are diverse and inclusive. And we're also pushing on things like Dorm Room Fund, which is an initiative we have at college campuses across the country to encourage entrepreneurship, to make sure that those efforts also sort of build community from day one that are diverse and inclusive. So I think that's where we are as a firm. For me personally, there's sort of been an evolution again from trying to do no harm versus being proactive, and I think it's anecdotal, but watching the impact of Haley Barna, who was she's a founder of Birchbox and now she's a venture partner with us, the impact that she's had on our partner meetings, and also just looking at the entrepreneurs she's meeting with versus the entrepreneurs that I tend to meet with, and how many more of them are female, makes me realize that if this is something we want to fix, we need to be proactive, and it's not good enough to treat everyone who comes in the door equal, but you have to go out and find people. So we're trying to find ways to do that as well.
Complementing what Phin was saying about specifically going in seeking the type of entrepreneurs that we want, under the Indie VC umbrella, half of our founders are female. Our best performing CEO, she's a black female in LA. We're not geographically bound. We have a female founder in Atlanta. We have actually 2 female founders in LA. We've backed a company in Pittsburgh, 2 in Chicago, New York, few in the Bay Area. So we'll go wherever the talent is. We definitely have the mindset of, wherever your seed was planted, that's where you should bloom, and we will try to give you the support that we can to help you succeed.
So I think one thing that people don't like to talk about in venture is that a do no harm position will do harm, right? So 2 reasons. One is that it's a very network-based business, and let's say most entrepreneurs and investors today that I might get referrals from, even in my network, not being a white male, are white males of a certain age, right? So that's a reality. Your pipeline is skewed already. And 2, it's a pattern matching business. You are looking for things that look like the other successful founders that you know, and that bleeds into lots of unconscious bias issues. So I think at Greylock, we think about taking personal responsibility for being proactive on those 2 issues that we've identified. And I would also agree with Phin that we are nowhere close to victory. But I guess 2 examples of things that I do personally are, if somebody comes from a background that is underrepresented, I am much more likely to take that first meeting because they've had to overcome barriers to get that meeting with me. And the second thing is that I run a monthly brunch for female angel investors and other product and go-to-market people that want to be angel investors because they're an important pipeline for us. And if I expand the diversity of sort of that feeder system, then hopefully the companies I look at will be different.
Thank you for that. Let's kind of get a little bit kind of tactical, or sort of kind of walk through the steps of networks are really important, right? So that's how you're going to get your referrals. So when a founder meets with you, kind of walk through like, so you have that first meeting, what gets them to a second meeting? What are you looking for in that first meeting that's going to lead to a follow-on second or third meeting?
Okay. So honestly, the first part is just getting that first meeting, right? So the best way is to get an introduction to me through my network, or come up and actually introduce yourself to me. We invest in people. We look at what you've done before, why you're unique for solving this problem, and we look for your tenacity. So getting the first meeting is the hardest. Getting that second meeting is, hey, when you say, Cynthia, guess what? This is what I've accomplished. This is what I've done since the last time I saw you. This is what I'm going to do next. If you keep pinging me, if you keep pushing me, sometimes we have founders, we meet them, and then maybe 2 years later we'll invest. But really it's about establishing that first introduction, updating us, and showing us your traction.
Yeah, so for me, I think every business is very different, and so it's hard to say that we look for this type of metric or this type of progress. I think you need the classic big market and a great entrepreneur, et cetera. I think my approach has been to view the first meeting really as an interview, and my job is to get to ground truth as quickly as I can, and so I try to study the business before the meeting and then work through figuring out if I believe you as a founder are the ideal person to attack this opportunity. And one of my favorite questions is to ask about the inception idea. Like, starting a company is very, very hard, maybe the hardest job you could have. It's one where you're very unlikely to be successful. And most people who choose to do it are extremely talented, so they have very high opportunity costs of sort of pursuing that opportunity. And so when someone really smart does something really crazy, I always like to know why, what's the motivation. And so truthfully, I ask people about why are they starting this company, where did the idea come from, and what is their vision for where it's going to go. And then I look and I see if they have goosebumps while they tell me that story, and that's sort of the key to getting a second meeting.
We share that same philosophy. We always start with the why. If we can't get past the why, we'll never get to the what and how and everything else. That said, the type of investing we are doing in looking for bootstrap companies who want to remain independent, folks who started their business not just to get out of it, but actually to run it. With that mindset, we actually look for people who've at least run their business for a year. That, to us, sends a signal that you have some understanding of your business. It wasn't Sarah and Nima got drunk on a Friday night and decided to make hoodies. So there's some thought behind it. And the why really leads us to that. And the year of working on an idea and struggling with it and learning tells us more about where you're coming from.
So I think two things I would point people toward that are not sort of the generic things that I started off with, which are, great entrepreneurs and a compelling offering and all of that, is I do think personal chemistry matters. So one thing I'm looking for is there any chance that I look at this person and I want to work with them for the next 5 or 10 years? Because that is how we think about it at Greylock. Like, do I want to help you build this business? And that's some part about the mission and some part about you, and hopefully you like me too if we're talking about working together. And then I think another part is Nima and Phin both just talked about this story. One of my partners, when I first started at Greylock, told me that a great company it's a crazy story told again and again to investors, to recruits, to customers, and to yourself until suddenly everybody believes it. Right? And I think one of the things that you should think about when you go into that first meeting is, what do I want the story that the investor understands to be when I walk away? And sometimes people, they don't try to wrap it up into that narrative, but that narrative is so important in terms of what sticks with the investor afterward.
One thing that just occurred to me as we're talking about this, and I'm not sure how to get at this, I don't know if all of you kind of have an answer to this, but one thing that I find for underrepresented founders that they struggle with is sort of like that first impression, and with the pattern matching, it sort of looks like a certain kind of story, it looks like a certain kind of spark, it looks like a certain kind of motivation. Particularly when I'm working with women founders, that will look a little different for women than it will for like, you know, a white guy. Or like, I guess I'm trying to understand, like, has your perspective changed on working with founders from underrepresented backgrounds in that first meeting? Because it's so crucial, and it's so based on pattern matching. Like, how do you think differently about that now?
Can I jump on this one? So
Yeah.
I've been doing a lot of thinking about that. I think we are in a business of looking for outliers, right? There's all these, people talk about the power law of venture returns and the idea that, you know, one company is going to return more capital, or is going to be a much bigger company than the next 100 that you invest in all combined, right? So we're looking for outliers. And so in that effort to look for outliers, I think where I start from is I believe that people's backgrounds, histories, and experiences shape their worldview. And if we believe that we have an economy today that is led by white men, right, and strategic decisions that are being made by white men in the Fortune 1000 for the most part, then who better to disrupt that economy in whatever industry you pick than somebody who comes from a different background, different worldview, and sort of has a new point of view on a given industry. And so my advice to when, you know, as you're meeting with women and underrepresented minorities is, don't try to fit a mold. Don't try to be a pitch that someone who looks like Mark Zuckerberg would give. Be yourself, because for the next 5 to 10 years, that's the person that we're deciding we want to work with or not. And you don't want to be pretending who you are every time you meet with us for every month for the next 5 to 10 years. And so I think you just really honor your perspective, honor your passion, come in and tell your story. And there'll be lots of people who say no. Maybe some of them say no for the wrong reasons, for the pattern matching reason. But you'll find someone who says yes. And like Sarah was mentioning, you tell that crazy story enough times, somebody is going to resonate with that story. And I think the only way you'll break through the noise is if it really comes from an authentic place.
So we look for founders with deep market insights and who have personal experiences who form why they have their company. So I want to know why this issue is compelling to you, what drives you, what puts that fire in your belly. Really, it's about you. You can have a great idea, but if you don't have that gumption in yourself, it's never going to go over. So really focus on telling the story about why you're the perfect person to lead your company, and also what experiences in your life made you realize this is a huge problem and this is how I can fix it. So it's very much kind of what you said, Phin. It's like, why are you so special? Do you really truly believe in the idea yourself? Are you uniquely qualified to solve it?
To the point of your story may not sound like the exact traditional Silicon Valley mold, I think that's true. And one thing that I would add to the points already made is don't feel like you need to have all of the answers, right? I think we are looking for like the kernel of vision and the kernel of this is somebody that other people will follow, and this is somebody that's going to hold on to this dream. But it's not, I think we're much more attracted to the idea that somebody is going to be authentic and care about the problem and be easy to work with and interested in learning than somebody who says like, you know, I've done this before, because much of our portfolio is first-time founders, and they range from, I think our youngest founder is 19, maybe he's 20 now, and like you just don't have all the answers, none of us do.
So there's a joke in finance, which is, you know, the only way to generate alpha is to be contrarian, and everyone agrees. So the thing we actually focus on is we want to fund the other. To us, alpha won't come from the same places as it did before. Or if we're looking there, then we're fishing in the same pond as everyone else, and that's not at least the type of investing we're trying to do.
That's really interesting. So I just want to make clear as well. So my experience is that if you come from an underrepresented background, sometimes you're a little more risk averse because you're the only one, and you know it's hard to kind of be that unicorn or to be that startup founder with gumption. And so I just want to, if one or a few of you can just make it clear, like when would you raise venture capital and when would you not raise venture capital, just to give folks a sense of like, oh yeah, maybe we actually shouldn't be talking to you. We should be talking to an angel or whatnot.
Normally I don't do this, but I actually wrote a blog post called "Not Every Startup Should Be Venture-Backed." So if you Google me, it'll show up. And I did this because I had some friends who came from a very traditional tech startup background in Silicon Valley. They'd worked at Google for a long time, and they're just like, oh, well, we have an idea, and we think it could be a business, and I guess we'll just raise $5 or $10 million of venture capital because that seems to be the thing to do. The real answer is that if you are at a large venture firm, the spec of what you are looking for in terms of capital efficiency and returns profile is actually quite narrow, right? You are looking for things that scale in a way that's unique to structurally advantaged software businesses. Even for us, we consider ourselves a long-term capital. That is a 10-year timeline to get really big. And I think rushing into a capital raise from a big venture firm is not necessarily going to be the best thing for every company. And so I think a sort of easy framework for you to think about is raise friends and family money to explore the idea, raise seed money when you have confidence in that idea and you've got that 6 months in front of you that you know what you need to execute on. Raise your A when you have that product or the beginnings of that product. Raise your B when you're beginning to see product market fit and going to market and trying to grow, right? So I think that's a basic train of how to think of the different stages.
I agree with Sarah. If you have a scalable business and you can generate revenue and you can bootstrap, you don't need a VC behind you. You only need us when you need extra funding to open a new market for a new product or for something different. But if you're able to scale and generate revenue on your own, you don't need us. Also, you need to make sure that your team is ready. So if my team is diligencing an opportunity and they find out that Phin and I don't get along as co-founders, that's going to hurt us. So you have to really make sure that you have all your affairs in order to survive a deep diligence. Otherwise, it could really, really hurt your company's integrity.
So I'm going to come out of Westfield with this one. Look, I think venture capital is great if you're Amazon. If you're building the next LinkedIn, great. Go raise venture capital. Exactly. LinkedIn. However, don't raise venture capital before you know your venture scale. Every time you raise venture capital, you remove optionality from your business. So when first round started, when OETV started, the idea of a seed round was to create optionality for founders. Now that's still true for some funds, especially B partners in particular, I would say. However, when you raise a seed round, there's almost an implicit Series A waiting for you. The old way people used to build businesses was you would have a 9-to-5, you would go home, kiss your spouse, kiss the dog, kiss the kid, work from 7 to midnight, work on the weekends, actually get some customers, and then when you've proven to yourself your venture scale, go raise venture capital. Then go make your outcome binary. I often like using the example of Qualtrics. They raised venture in the 9th year of their business when they did 48 million in top line and 30 million in cash. They were venture scale. Atlassian, GitHub, WooCommerce, BigCommerce, Spanx, Tuft & Needle, some of these never even raised money. Basecamp. I think there's more than one way to build a business, and all of us, you may never need any of us in the stack. Just keep that in mind too. Capital always has a cost. I think that's the key takeaway.
No, I totally agree with that. The first company I worked at was a basketball footwear apparel company. The original idea was a data business that would sell stats to college coaches. Then it evolved to a t-shirt business, and we sold t-shirts out of the back of a car. Then the t-shirts turned into shorts, and then the shorts turned into sneakers. And we had probably $150 or $200 million in revenue before we raised any outside capital beyond friends and family. And so you can clearly build very big businesses, and you can time the raising of capital to when you actually need it. And there always is a cost. And I think the way I think about this is less in the investor terms of seed, A, B, pre-seed, whatever you want to call it, and more in terms of the company. And as an entrepreneur, you have 4 stages of a company. I think you have inspiration, which is when you come up with the idea and you go look in your couch cushions for money to do tests and see if you actually have something real. You talk to friends and family. Maybe you put together enough money to just test something, see if you're right. Then you have aspiration, which is you start to understand maybe there's a market here, and you have aspirations to go from selling t-shirts out of the back of your car to destroying Nike. And when you have aspiration, then you have to align that aspiration with the capital that you need in order to achieve that. Maybe you can self-fund it, or maybe you have revenue and you can fund it that way, or maybe not. Then you have operation, which is, okay, now we're building this thing, and we have a wash, rinse, repeat cycle. And that's typically when you would go talk to Greylock, if you believe that that aspiration is large enough. And then you have scale, which is just, we need to put more money in one end to be able to have even more money come out the back end even faster, and you just get on this cycle. So that's how I think about it, is those 4 stages, rather than worrying about, is it friends and family or pre-seed or seed, or is it A or A plus or B, but think about it in those 4 stages.
So I'll just add one thing, because we've talked a lot about how your experiences shape your thinking and your passions. So my parents are engineers and entrepreneurs. They started a company called CASA Systems. It is a networking infrastructure company that I worked at for a period of time. It is based in the Boston area, which is not in vogue to do anymore. We crossed 100 million in revenue last year. The company's been profitable for a long time. And I think one thing that people, at least on Sand Hill Road in Silicon Valley, don't remember is that I came and pitched this company and everyone said no, right? So we bootstrapped the business. We couldn't raise venture. It is a venture scale business. Our first big customer funded us with equity about 2.5 years into the business. And then we raised, call it $100 million of growth equity when it was $30 million in run rate business, right? And so what I would say is, not only are there alternative paths that make sense for the vision you have, but also people get it wrong all the time. And I truly believe that. And I think most people in venture that are good at their jobs would have some degree of modesty about their actual judgment. I do feel like on this panel, we've talked a lot about why not to raise venture. I will give you a minute of why you might want to, because I believe in the Greylock product, otherwise I wouldn't work there. And the reason to do it is, if you have a business you think can scale the way a Workday or a LinkedIn or a Facebook can, then you want to be able to move fast. You want to be able to see forward strategically. You want to be able to hire above your weight class. And you want to usually win the market as quickly as possible. And capital and a network and people who have seen things across the portfolio and in their own experiences can help you do that. But I think the main point is that you need to make sure those incentives are aligned, because when they're not, then raising capital is not the right decision.
Okay, just one final question, and then I want to open it up to the audience. But I just want to ask if you have any other advice on how to develop a relationship with a VC. If it seems like you've taken a couple meetings, that you do start cultivating a relationship with the founder, kind of what does that relationship look like, and any advice for this audience and how to develop that relationship either pre or post a close of a round?
So for us, since we are pre-seed, the biggest compliment for me and my firm is when I meet with the founder and there might not be a fit for my firm, and I'll tell them why they're not a fit or what areas I want to see them work on. It's really, really hard for me to say no. I hate saying no, but I love it when I meet with somebody and they say, Cynthia, we totally understand we're not a fit for B partners, but I have a friend that I want to introduce to you. And you keep introducing me to your friends, and eventually we are going to find that right person. Or you might find somebody who you can introduce to me who's a subject matter expert who can help my portfolio. So there are lots of ways to relationship build. One thing that's very, very important is to really guard your own personal integrity when you're speaking with investors, because as investors, when I look at opportunities, I might see Phin or I might see Nima or I might see Sarah, and they'll say, hey, Cynthia, what are you looking at? And I'll tell them all the different things I'm looking at. Or I'll have a deal that I'm super, super hot for, and I'll say, hey, have you worked on so-and-so and so-and-so before? And they'll say, you know what? I worked with them, and they are not coachable. They're horrible. So be very, very careful about how you move yourselves professionally in the circles, how your team operates, and then also the circles with which you run in, because they totally reflect upon you.
I guess I would say time is your most valuable resource, and don't waste it talking to VCs. You're going to get much better advice from entrepreneurs and peers. And I think when you start talking to investors, you should do that when you're ready to raise money, because regardless of what we say, we're always trying to decide whether this is an investment opportunity or not, because we're just like programmed that way. And so I think spending a lot of time with investors when you're not raising money, asking for advice. Angels, I think, is a little different because they may have operating experience that's relevant. But for most VCs, they're talking to you as an option on your time, and they can string you along for a long time. And I think as an entrepreneur, my favorite VC was the quick yes and a term sheet where I got to fill in the price. Second favorite was a quick no with a reason that may or may not be right, but something that I could sort of understand where they were coming from and maybe learn something from. And the worst is a long drawn out maybe where, oh, if you have a little more traction, come back to me. And oh, if you have, one more customer, come back to me. And you just waste a lot of time doing that instead of building your business. So my advice is don't talk to VCs.
I'm going to disagree with Phin a little bit right now. Amy Chang is one of my favorite female entrepreneurs. She's the founder of a company called A Company. You should try it. It's an app. And she gave a talk recently at one of our events called Raise Before You Need to Raise. And the concept here is that, at least at Greylock, we are very relationship-based as a firm. And if we meet you and you are trying to raise money and we need to make a decision that week, even if we have the mechanical ability to move quickly and to analyze the market and make a decision, we don't know you, right? And these are very, very long-term relationships. A running joke in Silicon Valley is that your board member relationship lasts longer than the average American marriage now. So we think of it that way, and if we've had 2 meetings with you, it's hard to jump into marriage. I do think that hanging out with VCs that are not well qualified to capitalize your business for the stage it's at is a massive waste of time. And you'll see growth investors or investors who don't have the ability to fund you at the stage and level you want, just kind of information dig. Don't take those meetings. Take meetings with people you think can help you or you think will actively be an interesting backer for your company in the next year or so. Because we do want, one saying we have is, one dot is an aberration. One meeting, I could like that person, but it doesn't mean that much to me. 2 or 3 or 4 dots is a line, and we've begun to build, hopefully, a long relationship.
So treat fundraising like any other sales process. I've been in sales my entire career, whether it's been shipping labels or pizza or group coupons or boom boxes, it doesn't matter. You always want to get to a yes, no, or I want to learn more. There's only 3 stages. So push the investor. If the investor doesn't have the time/guts to tell you no, push them. And if they don't respond to you, just move on. It's not worth your time. Our promise to all the people we talk to is that we will give you an answer in 7 days. And more often than not, just by the numbers, it's a no. But we'll give you a reason and we can all move on with our lives. But get to a yes, no, want to learn more. Those are the only 3 stages that matter.
Okay, so I think we have a few minutes for audience questions, and I'm not sure. Okay, the mic, great. So it looks like we've got one question up here.
Thank you. Hi, this is exciting for you guys to be here. My name is Pamela Gustav, and I'm the founder of Ride a Club. It's Rideshare Independent Drivers Alliance, and basically what I'm doing is helping drivers to start their own little mini businesses within their zip codes. And so the thing is, I'm not an engineer, and so I have to figure out how to actually make that happen. And so I'm here actually looking for a co-founder, and I think I might have found one. It's this young guy, he just gets it. And it's exciting. The thing is that, you said something about scaling fast, and that's how I envision Ride a Club. That's what it's called. I could change it. But anyway, the point is that I just feel like now, because I'm a rideshare driver, I got kicked off of the Uber app because I wasn't trained properly, and then the app had a bunch of issues, and I got so upset. I'm like, what if I had kids and you kicked me off of my job? And so the thing is that So that's why I started this, because what if you have kids and you get kicked off your job? And so, I can't believe I'm crying in public, but anyway.
It's okay.
So anyway, the point is that I asked 400 of my riders and some drivers, like, what do you guys want? And then they basically gave me the business that I have now. And it's drivers by zip. It's like if you can have drivers like right in your own zip code that live near you, then you can contact them. And then if they want to drive Uber, Lyft, or whatever, that's fine. But the point is that how can I even get to that point? Because I drive for Uber. Not for Uber anymore, obviously. I drive for Lyft. I love Uber, by the way. I don't have anything against them, because if they hadn't kicked me off the app, I wouldn't see this problem. And so the thing is that how can I get my business like off the ground, like every day and every night? This is all I do. And I try to create any kind of apps that are existing to make what I'm trying to create. But anyway, so what is your suggestion on how to just get it out there faster?
Thank you for sharing. I think that this, like a more general characterization of the problem is that there are a million barriers at the beginning to getting the first product out, right? And I think a thing that is exciting now is that there are incremental ways to start, right? And that could range from there are now prototyping tools where you don't have to be technical to explain what your idea looks like and show users, does this make sense to you? And investors, does this make sense to you? There are hackathons that are, weekend-long events where you can hold your day job or whatever else you're doing and still experiment with an idea. And I do think that, like, the cost to start a business is still extremely high for anybody who needs to support themselves. And like the thing we're looking for is like, can you find all of the different hacks? And it could be prototyping, it could be working like more slowly over a set of weekend projects, it could be hackathons. But I think about maybe not try to get the product out all at once, and this applies to anybody with a large vision. Like, it's going to take a long time to build, and like what are the very first steps that I can take to get a little bit of feedback?
Thanks very much. What's the current interest in VR, AR technology among VCs?
For us in our partnership, it's interesting and it's going to happen at some point, but it's hard to know when. And so I think we've seen lots and lots of entrepreneurs working in those spaces, and we've found a couple partnerships. But I think the thing that we've focused on is looking at business models that can be self-sustaining while you wait for the market to come, rather than businesses that require ongoing financing, no quick path to revenue, but are waiting for sort of the big bang to occur where everyone throws away their TVs and puts on goggles, right? And I think so market timing is a very hard risk to take on. And so as an entrepreneur, when you take on market timing risk, everyone knows it's going to happen, but nobody knows when. Making sure that you have a path where you're not dependent on the existential risk of Sand Hill Road deciding that VR is 20 years out, not 3 months out, to sustain your business.
To complement that real quickly, traction and real revenue walks everything else, including both. Like, just forget it. I just read an Indian company bootstrapped to $1 million, and they're in that space, and it shocked me. Yeah, like somehow they found a way to generate revenue. If you do that, you have every optionality.
Hi, how are you? My name is Doris. And I wanted to ask you, at what point should we approach to investors? Like, I have a really good idea, some users are interested, I already created my prototype, or it's just like, hey, I have some traction, users are coming. When is the right moment to approach to an investment company? Especially because if you're like from not the US, like I'm from Honduras, right? So we approach to you, right? At what point?
I think there's, especially on this panel, we kind of have very different representation of different styles of investing. So I would say research the type of investors, right? So she invests pre-revenue. Some of us invest only at revenue. Some of us invest perhaps at scale. So I would just say, like any other sales prospect, really study who you're reaching out to. So then there is a universe of people that focus on different stages.
So I encourage anyone who's thinking about approaching one of us to look at our portfolio, look at what we currently invest in, read our social media, read our blogs, do your homework on me before you come meet me. I love it when I meet a founder and they completely work me over. They know exactly what I'm looking at. They know what I've been writing about. They know what I'm hot for, but they also know what I don't do. If you come to me and you're raising your Series B, you're wasting both of our time. So totally do your homework on the investors before you approach them. If you can, get a warm introduction. Find somebody who knows me. So when I get an introduction from somebody who's warm, I answer it right away. If it's somebody who's cold, it may take a couple of days. The interest level may be very, very low. Again, it's about those relationships.
Thank you so much. Let's give a big applause to Sarah, Nima, Phin, Cynthia, and Katherine. Thank you for joining us today.